The lights went out in Shanghai. Not literally, but functionally. On January 1st, 2026, something shifted in the global silver market that most people won't understand until it's too late. The Shanghai Futures Exchange, the beating heart of Asian precious metals trading, just signaled something that should terrify anyone paying attention. The vaults are running dry. The premiums are exploding. And the Western world is about to learn a very expensive lesson about the difference between owning a contract and owning metal. This isn't speculation. This isn't fear-mongering. This is documented market behavior that is screaming one message: the physical silver market is breaking. In this investigation, we're going to dissect exactly what happened in Shanghai over the past 2 weeks. We're going to explain why Chinese buyers are paying prices that make no mathematical sense unless you understand what is really happening. We're going to show you the export restrictions that just turned China from a supplier into a hoarder. And we're going to explain why this 2026 supply shock isn't a future threat. It's happening right now, in real time, while the Western analysts are still debating last year's data. The supply shock is real. The countdown has started, and Shanghai just fired the warning shot that no one wanted to hear. Let's start with the numbers that don't lie. In the final week of December 2025, the Shanghai Gold Exchange reported silver premiums that broke every historical pattern. Physical silver in China was trading at a $6 to $8 premium over the London spot price. Read that again. $6 to $8 per ounce premium for the exact same metal, in the exact same purity, separated only by geography and delivery time. This is not normal market behavior. In a functioning market with free capital flows, arbitrage would close that gap immediately. Traders would buy cheap silver in London, ship it to Shanghai, and pocket the difference. That's trading 101. But here's the problem. They can't. The metal isn't moving. The ships are delayed. The export licenses are frozen. And the Chinese buyers who need silver today are trapped in a bidding war with each other while the rest of the world sleeps. This premium is the market's way of screaming. It's screaming that paper promises in New York mean nothing when a factory in Shenzhen needs physical bars to keep the production line running. It's screaming that the futures market and the physical market have divorced, and the physical market is telling the truth. Now let's talk about what changed on January 1st. China didn't announce a silver export ban. That would have been too obvious, too provocative. Instead, they implemented something far more effective: a refined silver export licensing system. As of the new year, only 44 state-approved companies can legally export refined silver from China. Not ore, not concentrate. Refined, finished, ready-to-use silver bars and granules. Do you understand what that means? China just took control of the valve. They can open it when they want. They can close it when they want. They can decide who gets metal and who doesn't. And they are doing this at the exact moment when global inventories are at multi-year lows and industrial demand is at all-time highs. This is strategic resource control disguised as regulatory reform. China learned this playbook from rare earth elements. Control the refining capacity, control the export channels, force the rest of the world to either pay up or move manufacturing closer to the source. It worked for rare earths. It's about to work for silver. Here's what most analysts are missing. China is both the largest producer and the largest consumer of silver. They mine it, they refine it. They use it in solar panels, electronics, batteries, and infrastructure. Their domestic demand is so massive that even their own production isn't enough. So when they restrict exports while their internal consumption is surging, what do you think happens to the global supply available to everyone else? It evaporates. The West has been operating under the assumption that Chinese silver would always be accessible. That assumption just died. Let's talk about why this matters more in 2026 than any previous year. The global silver market has been running consecutive annual deficits. That means every year, the world consumes more silver than it produces. Where does the deficit get filled? From above-ground stockpiles, from vaults, from inventory that was accumulated in previous surplus years. But here's the crisis. Those stockpiles are depleting. When all three major vault systems are draining simultaneously, there's no backup. There's no emergency reserve. The system is running on fumes, and one unexpected shock, like a Chinese export restriction, can flip the market from tight to catastrophic in a matter of weeks. Now let's connect this to the real world. Who needs silver and what happens when they can't get it? Start with solar manufacturers. Every solar panel contains silver paste for the electrical contacts. China is the world's largest solar manufacturer and installer. Their government has mandated aggressive solar deployment targets for 2026. So Chinese factories are consuming silver at an accelerating rate, not a declining one. Then add electric vehicles. EVs use significantly more silver than internal combustion vehicles due to all the electrical components, charging infrastructure, and battery management systems. China is also the world's largest EV market. More EVs means more silver demand locked inside the Chinese economy. Then add semiconductors. Silver is essential in high reliability electronics. As China pushes for semiconductor self-sufficiency, they're building fabs that consume silver for bonding wire, conductive adhesives, and contacts. That's more domestic demand that doesn't leave the country. Now imagine you're a European or American manufacturer. You've been importing refined silver from China for years. It's been reliable. Prices were reasonable. Delivery was consistent. Then January 1st hits. Your supplier calls and says their export license didn't get renewed, or it got delayed, or it got approved but with volume restrictions. What do? You panic. You call every other supplier. But they're getting the same story. The metal that was flowing freely 2 weeks ago is now stuck behind a bureaucratic wall, and the only way to secure supply is to go to the spot market and outbid everyone else who's in the same crisis. That's how premiums explode. That's how backwardation appears. That's how a market that looked stable on December 30th looks catastrophic on January 5th. Let's define backwardation because it's critical. Backwardation is when the spot price of silver, the price to buy it right now, is higher than the futures price, the price to buy it in 3 or 6 months. In normal markets, futures trade at a premium because of storage costs and time value. When that flips, it means the market is screaming for metal today and does not trust that the future will have any. Silver flirted with backwardation in late December. If it locks into sustained backwardation in January, that's the market confirming that the supply shock is real and immediate. Now let's talk about the paper game and why it's about to fail spectacularly. The silver futures market operates on the principle that most contracts will never result in physical delivery. Traders buy and sell the idea of silver, not the metal itself. As long as everyone plays the game and settles financially, the system works. The exchanges can issue contracts representing far more silver than actually exists in their vaults because they know 95% of those contracts will be closed before delivery. But what happens when industrial buyers stop playing? What happens when a solar manufacturer or an electronics company says, no, we're not accepting cash settlement, we need the metal? That's when the game breaks. That's when the exchange realizes they sold 100 claims to the same ounce of silver, and only one person can actually take delivery. This is the Achilles heel of the paper silver market. It works perfectly until physical demand overwhelms the system. And with Chinese exports restricted, Western vaults draining, and industrial demand surging, we're approaching that breaking point. Here's the scenario that keeps vault managers awake at night. A large industrial buyer stands for delivery on their COMEX contracts. The exchange scrambles to source the metal, but the metal that would normally come from Chinese refiners is now trapped behind export restrictions. The metal in London vaults is already spoken for. The metal in New York is declining every week. So the exchange does what exchanges always do when caught short. They offer a cash premium to convince the buyer to settle financially instead of taking delivery. But if the buyer refuses because they literally need the metal to keep their factory running, what then? The exchange either defaults on delivery, which destroys confidence in the entire system, or they pay whatever price is necessary to source metal from holders who don't want to sell. Either outcome sends the price into a vertical spike that makes every previous silver rally look tame. Now let's talk about lease rates because they're flashing red. The silver lease rate is the cost to borrow silver for a short period. When lease rates are low, it means silver is abundant and nobody's desperate. When lease rates spike, it means someone needs metal urgently and is willing to pay dearly to borrow it just to make a delivery or fulfill a contract. In the last 2 weeks of December, silver lease rates jumped to levels not seen in years. This is industrial buyers and dealers scrambling to secure metal for near-term obligations. It's the financial market's version of a factory foreman running around trying to find parts before the production line stops. High lease rates combined with wide premiums, combined with draining inventories, combined with export restrictions, equals a market under extreme stress. And stress doesn't resolve gently. It resolves with a snap. Let's talk about the mining response, or rather the lack of one. When silver prices rise, the textbook says miners will increase production and new mines will open. That's the theory. Here's the reality. Most silver comes as a byproduct of copper, zinc, and lead mining. Silver miners don't control the production volume. The primary metal economics do. So even if silver goes to $100, if copper prices are weak, the silver production doesn't surge. And even if a company wanted to open a new primary silver mine, we're talking about a 7 to 10 year timeline. Exploration, permitting, financing, construction, commissioning. You can't speed up geology. You can't shortcut government approvals. The supply response to today's shortage won't arrive until the early 2030s at best. That means the 2026 supply shock cannot be solved by new mining. It can only be solved by demand destruction, factories shutting down because silver is too expensive, or by price rationing, where silver goes high enough that holders who don't absolutely need it start selling. Here's what to watch in the coming weeks to confirm this thesis. First, watch if Shanghai premiums persist or widen. If Chinese buyers keep paying $6 over spot, the restriction is biting hard. Second, watch COMEX and LBMA inventory reports. If registered silver keeps declining while open interest stays high, the claims per ounce ratio is getting more dangerous. Third, watch industrial news. If you start seeing headlines about solar manufacturers delaying projects or electronics companies warning of component shortages, that's the real economy, confirming the metal isn't there. Fourth, watch for delivery delays. If refiners or dealers start quoting longer lead times, 6 weeks instead of 2 weeks, that's the supply chain stretching. Fifth, watch for policy responses. If other countries start talking about strategic silver reserves or export controls of their own, the crisis is going international. The Chinese move is the catalyst, but the underlying problem is structural. Years of deficits have depleted the buffer. Industrial demand has become so large that it's no longer optional. It's the floor bid in the market. And the paper market has issued so many claims that a delivery squeeze is inevitable if enough participants demand physical settlement. This is not a prediction of silver going to $200 next week. That's not how supply shocks work. They work in stages. First, premiums widen, then lease rates spike, then inventories hit critical lows. Then a delivery issue becomes public, then confidence cracks, then price gaps violently as the market reprices from commodity with some tightness to strategic resource and shortage. We're in stage 3 right now. Shanghai running dry is the headline that confirms we're transitioning from tight to critical. The next stage is when a major buyer can't secure metal and either halts production or pays a price that makes headlines. When that happens, the herd wakes up. Suddenly, everyone who thought silver was just another commodity realizes it's the metal that enables the energy transition, the digital economy, and modern manufacturing. And they all try to secure supply at the same time. That's when shortage becomes scramble. That's when price becomes secondary to availability. That's when the question shifts from how high will it go to can I even get it? Shanghai didn't run out of silver because of a sudden demand spike. They ran out because the policy environment changed, export controls tightened, domestic consumption surged, and the global buffer that was supposed to handle disruptions had already been depleted by years of structural deficits. The 2026 supply shock isn't theoretical anymore. It's documented in premiums, in lease rates, in vault data, and in policy changes. Shanghai is the canary in the coal mine. And the canary just stopped singing. Watch the physical market. Ignore the paper noise. The truth is in the vaults, the premiums, and the delivery delays. And right now, all three are screaming the same message. The metal isn't there.